Welcome to Variety's third quarter earnings coverage. I'm Heidi Chung, media analyst and correspondent for Variety Intelligence Platform. Netflix released third quarter financial results Tuesday after the bell. The media powerhouse reporting a beat on the top line, but a miss on its bottom line. Subscriber growth disappointing investors at just 2.2 million paid sub additions compared to Wall Street's estimates for 3.3 million. Elaine Low, Variety's senior reporter, is here to help break down Netflix's results. And Elaine, we have to start with what matters most to investors and analysts, right? It's that paid subscriber growth, obviously disappointing by a pretty wide margin, and a big miss when it comes to guidance for Q4 as well. It expects 6 million paid sub additions in Q4 versus 8.8 million in the same period last year. So bottom line here, it seems to me that subscriber growth is just slowing exponentially. Why do you think that growth momentum took such a big slowdown following big growth that we saw earlier this year?
Well, that's a good point. Like you mentioned, 2.2 million, that comes in below Netflix's own targets for the quarter, as well as analyst forecasts. And really, to hear Netflix execs tell it on the call, they are not focused on the quarter-to-quarter fluctuations, right? They want everyone to look at the big picture. They remain the dominant streamer with over 195 million total subs across the world, including over 73.1 million in US and Canada. So they're focused on the long term. Naturally, the market is taking into account today's disappointing sub action, driving pressure on the stock. But Netflix believes that they're still in the early days of internet entertainment, as they put it, and they're expecting many strong years of future growth. But certainly taking a look at the breadth of competitors that Netflix has, especially when you're looking at a Disney Plus, which has already racked up over 60 million subscribers in just less than a year, certainly is something that the market is watching closely.
I also do want to get your thoughts on the financials here, because Netflix's revenue was up just under 23% over last year, and it was the 30th consecutive quarter of over 20% year-over-year growth, but it was also the slowest year-over-year growth rate since Q1 of 2019. And again, Q3's EPS miss was its biggest ever. And then we take a look at free cash flow, and it seems that they're expecting to see a bit of a slowdown on that front as well, slightly negative in Q4, and then down 1 billion to break even in 2021. So what should we sort of make of these numbers?
So free cash flow, that's the one that gets Netflix a lot of heat, right? Everybody's always talking about their massive content spend, just the amount that they're willing to shell out for the prestige TV and movies that they offer on the service. And I think it's been really interesting. This is actually the third consecutive quarter of positive free cash flow. But largely because productions have been shut down, and so they haven't been able to spend as much on creating that programming. And what will be interesting in the coming quarters and years to come is to see how that figure stabilizes. They mentioned that they are not yet sustainably free cash flow positive, but at this stage, they can self-finance growth without needing to access those capital markets. They are still, though, a couple of years away, they said, from being sustainably free cash flow positive. And I think the thing that a lot of folks are going to be keeping a close eye on is how they're able to make that a sustainable figure, given that we all hope is just a one-time event, this coronavirus pandemic, which has shut down so many different parts of the economy, including Hollywood.
And Elaine, looking at this sort of from a stock move perspective, Netflix has been the ultimate COVID play, right? We've seen shares skyrocket as a result, especially from the beginning of this year. It's up a whopping 62% before the after hours move so far in 2020. And that's pretty impressive when you compare it to the S&P 500's more modest gain of about 6.5% in the same time period. So I'm wondering what your thoughts are in terms of the stock, right? Is there more room to run from here? Or do you think investors are going to start to take some profits because, like you mentioned earlier, competition is just ramping up in the space? It's oversaturated when we're thinking about streaming. Where do you see the direction of the stock from here?
Well, analysts are still largely positive on this stock, right? I mean, I'm sure you've seen over the last few quarters, especially given that everybody is cooped up at home, everybody's watching more TV, and everybody's really tapping into more streaming services. I mean, even though everybody is locked up in their homes, they're still largely looking at on-demand programming instead of broadcast and linear. So that definitely points to a trend line that we're going to continue to see, and that has largely been accelerated by the pandemic. And I think the question that Netflix is going to have to face in future quarters is just how they'll be able to hold on to and sustain that lead that they have in the streaming market. Again, the only other player that's really come reasonably close or perhaps alarmingly close to challenging any kind of dominance that they have is Disney Plus. And even then, we're looking at 60 million globally versus 195 million. So even in that realm, there's still a huge amount of catch up to be made there. Netflix is at this stage, I think, largely in terms of future sub growth looking abroad. They've been focusing much more on international growth, which is why they've been focusing much more on creating programming overseas with the recent installation of Bella Bajaria as their head of global TV. That's another nod to just where their focus lies right now. And it doesn't seem to be in the US.
So Netflix kicked things off when it comes to media industry Q3 earnings. Not really the best results here. And so I want to get your opinion on what you think we can expect from the rest of the group. We have, again, AT&T on Thursday, and then Comcast next week, and then Disney in November. So do you think investors should sort of brace for the worst at this point?
It's funny that you mentioned Disney. I mean, the state of California recently issued theme park reopening guidelines, and it looks like Disneyland is not going to get a chance to open for quite some time until Orange County manages to bring down its coronavirus case rate to a more modest level. So when you're really looking at a company like Disney, or if you're looking at a company like NBC Universal, these companies that don't rely purely on TV or their studio work, but have a theme park component as well, and a merchandising component that often relies on theme parks as a marketing tool, you're looking at a lot of other things in play. And really what we're looking at long-term here is how much longer is this pandemic going to last, right? And what kind of sustained impact is it going to have, not just on studio production, but on, when these theme parks will be able to open at limited capacity, at full capacity. There's just there's a lot of moving parts right now. And I think that this quarter of media earnings is going to give us a glimpse into what we can expect down the line in that regard.
Elaine Low, Variety's senior reporter, thank you so much for helping us make sense of all of this. And for more in-depth analysis, head over to variety.com/VIP.